ladies and gentlemen, and welcome to FTE headquarters. I'm delighted to introduce my guest today, Robert Farago, Head of Asset Allocation at Schroders Private Bank, for the latest in our series of PWM interviews. Robert, is the asset allocation decision the balance between equities, bonds, and alternative assets? Is this still the most important one that private clients need to make when they're structuring their portfolio? Obviously with a bit of help from yourselves.
Yes, yes, very much so. I think that is the key decision that will determine the overall risk level of their portfolios. So for a client with a very long-term view, it still makes sense to have the majority of their assets in equities. If you have a shorter-term horizon, equities are very volatile and you need to have a more balanced portfolio and balancing with other assets such as bonds and alternatives. I think the real challenge for investors right now is that bond yields are very low, below the level of inflation, and don't look attractive, and that makes balancing equity risk that much more challenging.
And this great rotation we've been hearing about, is that something of a myth from bonds to equities, or has it been happening in reality?
I think it has been happening, it has started this year, but not really from government bonds into equities. The real shift has been from emerging market debt in particular and other higher yielding assets into equities. And the trigger for that has been talk of tapering in the US. So we've had a very subtle shift in stance from the US Federal Reserve. They have talked, before they have said they will stop their quantitative easing policy if the economy gets better. They're now saying they will stop quantitative easing unless things get worse. And although that's a very subtle shift, it is the first move towards tightening we've had since the start of the financial crisis. And I think what's changed in the way the Fed managed the market is that the language matters a lot more. So back in 1994, which is a period a lot of investors are looking at to compare the current environment, because we had an unexpected rise in interest rates that had a big impact on markets, with bond yields shooting up and equities coming down. So this time round, a slight change in language has led, in some cases, to a similar moves in the same direction.
And Schroders were making brave forecasts at the end of 2012 that the European market would be a key one to watch during 2013. Are you still as confident about the future of the European market as you were maybe 6 months ago?
I think what's changed, what has played out in our favour is on the interest rate side. So where we were confident was that we felt that the big rise in bond yields that we saw last year was unlikely to be repeated. We thought the European Central Bank had put in place policies that could act to calm the crisis, and that has proved correct. Looking forward, have they solved all the problems? The answer is clearly no, that we haven't got to the ultimate solution, and the risk therefore is that once again you will need a crisis to trigger more political action to get us towards the end game, which would be a proper fiscal union and a banking union. But in the meantime, we do see value in European equities. So although there is that uncertainty out there, we still can find enough good companies trading at cheap valuations that we maintain positions in Europe.
And we haven't mentioned China yet. We've seen a slight slowdown from 7.5% to maybe below 7%, depending on which are the best figures to follow. Will this be a serious problem? This kind of level of this marginal slowdown in Chinese growth?
I think it's right to be concerned. Yes, China has been boosted by a massive credit stimulus in the aftermath of the financial crisis, and that that rate of growth in credit is inevitably going to lead to some bad lending. What you've seen in China is the new authorities have come in and they seem to be talking about more prudent lending, and ultimately that will be good news because the growth will be on a sounder footing. But in the meantime, I think what it means is that growth is likely to slow further. I think the other thing is from a corporate profitability perspective, that massive growth in credit has meant big overinvestment in a number of industries, and therefore our expectations for earnings are, we expect earnings to slow as well. I think the slowdown in growth is not just the real growth number, it's the nominal growth number. So as well as seeing growth slow, you've seen inflation slow. And from a company perspective, it's really the nominal growth that drives their profitability. So that slowdown, if you've been planning for 18% nominal growth and suddenly it's nearer 10, that's a big shock to the system.
Is that the biggest risk to equity investors, this potential or even ongoing Chinese slowdown, or is there something creeping up behind us that that the rest of us aren't necessarily aware of that can really hit equity portfolios?
I think it's the most obvious risk. Perhaps the other one to highlight is the impact on the other emerging markets. So in general, emerging markets have enjoyed very strong inflows for a number of years. They have had the very unusual backdrop of strong commodity prices combined with very low interest rates. As investors have started to withdraw money from their bond markets after yields hit record lows, you've now got a fairly uncomfortable position where interest rates are rising or bond yields are rising at the same time as growth is slowing. On top of that, currencies are weakening, and I think that is likely to continue because competitiveness has been eroded over the last decade as the economies have grown and inflation has picked up. And that's not good news either.
And closer to home, it may be in slightly less glamorous locations. I hear you've been looking at UK property as a diversifier, the commercial property, maybe some warehouses on the North Circular Road or in some industrial estate. Are these things that private clients should also be looking at as part of their portfolios?
We're not focusing on any particular area such as the North Circular, but in general we think UK commercial property does look attractive. The nature of property markets is they don't change direction very often, and we think we are at a turning point. There are a number of things that work in favour of property at the moment. So in the UK, interest rates are expected to remain low for some time. The economy is stabilising, and generally availability of capital is becoming easier. So even this year, we've seen 50 new lenders come into the UK commercial property market. It's a fairly attractive. The UK is a very attractive destination for international investors. It has a stable legal system, a very good market, and therefore we are seeing money coming in. And we think that at a time when just about any other asset offering a decent yield has done extremely well over the last 3 years, property has been a laggard, and we will see money begin to flow into the market. So we do see upside for commercial property. There are 3 different areas: industrial, office, and retail. Retail is somewhat more challenged, although you can find niche positions, but London office remains an attractive market. And I think the big
particularly where we're sitting now, I assume.
Well, indeed. And although you can see a couple of new buildings coming up, in general, supply has been quite limited. And so this last cycle has been very different from the 2 or 3 previous ones, where you had a boom and bust that was driven by massive oversupply. So in this case, it was all about financing. And now we think the finance situation is more stable. We think you can expect modest increases in prices, modest increases in rent, and that's enough, together with an attractive yield, to deliver really quite attractive returns.
and hopefully modest increases to your clients' portfolios
Indeed.
as well. Thanks very much, Robert.
Thank you.